the key thing is when you open up these options chains and you look at open interest and volume, you can see how a majority of the volume is all traded with 1, 2, 3, 4 days left to expiration. Now, for those that don't know what open interest is, basically that's this column here. That is the number of options contracts that are outstanding, that people own. Okay, that people have either bought to open or sold to open. So they're outstanding open option contracts that people own somewhere out in the world. That is what open interest is. Volume is the amount of option contracts traded today. And as you see here, we look at the Qs, that's the NASDAQ 100, and we look at all these options. Look at all this volume that's taken place today. 30,000, 28,000, 57,000, 54,000, 59,000 contracts, 41,000 contracts, 42,000 contracts. You get the point. And you go out to next week and we look and we see same thing. Lots of options contracts traded. Okay, 15,000, 5,000, 6,000, 4,000, 6,000, 12,000, 3,000, 4,000. And the high volumes are all now being concentrated towards the expirations that have 10 days or left to go. And as you can see, as we go further out, now we go out 6 days, you have 1,500, 3,000, 1,200 contracts traded. We have, 1,500, almost 3,000 contracts. But as we're going further out in time in the Qs, we have less and less volume. So all the volume is being concentrated on the 0 DTE options, 0 or 1 day to go till expiration. Here we go out 7 days. You really see the volume drop off. You get 3,000, 1,500, 2,000 contracts, 1,000. But as you can see, it's getting less and less and less. And we go out to 8 days to expiration. It's getting, and this is a main expiration. This is a key expiration. It's a monthly regular expiration, and that's why the volume is a little higher here. But still, even with this major expiration, it still doesn't pack enough punch to compete with the volume with 1 day to expiration. See? And, look at the 0 DTE. Look, we're getting even more. I mean, this is huge. Hundreds of thousands of option contracts traded. So let's take a look at the spot to get this point across. Okay, 200, 300, 400,000 contracts traded. Look at this. It's huge with 0 DTEs left. That's what that 0 is. These options expire today. We go out 1 day to expiration, and same thing, huge volumes, but not as big as the day before the options that expire today. And we go out, 5 days left to expiration. Still decent volume, but not as big. So the key thing is that all this volume that is taking place in the SPY today, in these 0 and 1 day to expiration options, and also in the Qs. See here, but also in now individual stocks. We take a look at Apple with only 1 day to expiration, huge volume. See, huge volume with these options that expire in 1 day. Take a look at NVIDIA, same thing. Look, huge volume with only 1 day to expiration. All this volume that's taking place with 0, 1 day to expiration, that is what is moving the market up and down. You're getting these huge moves, and in the stocks and in the indexes. And these options don't trade overnight. So you're not getting the huge moves overnight in the early market for the most part. Look, the options aren't trading overnight, and you don't get the big moves in the futures like you used to in the olden days. Because as they're trading these 0 DTE and 1 DTE options in the index ETFs and in the individual stocks, market makers hedge those options by buying and selling futures contracts.